Hi, and welcome to the Restani Center's Perspectives on Impact Investing. I am the Impact Investment Residence at the Restani Center and an adjunct assistant professor of strategy at Chicago Booth. And I also manage Impact Engine's private equity impact fund. And we're going to cover today really a history and overview of the current state and future state of the impact investing industry. Both in terms of the basics, in terms of what does it really mean to be an impact investor, what are examples of impact investments, but also careers in the field, how you get the proper training, what are certain trends, where do we think it's headed. I've broken up the presentation into two parts. The first one will cover the history and a little bit of a landscape overview, and the second will speak more specifically about real impact strategy examples, both at the fund level as well as the company level, as well as careers in the field. So first, by way of background, I want to share a little bit about my career history and what brought me to this point, because I think it's illustrative of what how a lot of people find themselves in this industry. So I started out right out of college being really interested in using my background in business and as an entrepreneur to affect social good in the world. I did a year-long history project or independent study with a history professor looking at the history of social movements, the role corporations played. And it was actually through that I saw the role of investors and how powerful they are in actually influencing corporate behavior, in addition to the pillars of government as well as consumers and what they demand of their companies. But I was really interested in the role investors play. And so I went to KLD, Research and Analytics, down here, number one, which was the very first ESG ratings provider. We did research, social and environmental research on public companies and sold it to financial advisors to build portfolios of socially responsible investment companies. And my role there specifically was actually to help take this research and mainstream it, sell it to mainstream asset managers. And amongst them, we licensed our index to iShares to create the first ESG ETF at that firm, and a number of other banks, which led me to number two Northern Trust in Chicago, which many of you may know is a mainstream, not an impact investment firm, not like KLD, did not have this commitment from the beginning of the firm. But I saw an opportunity there driven by client demand to create ESG products for their clients to invest in. And so I developed the business plan for them to offer ESG funds and other products and went about doing that. So you can see the impact intent is less, and it's kind of in the middle because of my role and what I was doing there. But the financial intent was there to provide the same type of financial returns and outcomes as anything else the firm was offering. I then went to Aurora Investment Management, which was a pretty large and well-known fund of hedge funds. We built portfolios of hedge funds for institutional clients. And I went there because I wanted to get the financial skills to really invest for good. And I recognized that a lot of folks in the ESG and impact investment industry didn't have that. So Aurora itself had no impact strategy or mandate. It was purely financial. But I, along with a lot of people in this field, do sometimes take a portion of their career to really focus on developing the hard technical skills, which is very important, in order to do that with impact. Which brings me to number four, the Schwartz Family Office. This is a large single family office where, again, the firm as a whole, it's not an impact investment firm, it's not an impact family office, but there were certain pools of capital and certain clients and family members where I was developing impact investment strategies, and they are also fairly engaged in philanthropy. And then finally, I'm at Impact Engine now, where our firm, everything we do is focused on generating strong financial returns, so it's high up on the y-axis, as well as really intentional, measurable social impact, all the way down on the x-axis. And so it sometimes takes a few points in your career to develop the full skill set to be able to do both of these really, really well. And so that brings us to the question of what exactly is impact investing then? And what you see here are two definitions that intersect in a few ways, and these are common definitions. One is you see the word intention or intentionality bolded, meaning the investor has to be trying to create social impact. It cannot be accidental. And that's because their investment strategy and process, all the way from the way they source to how they manage their investments and exit them, should have that impact intentionality. The second thing is this focus on measurable impact, as well as a financial return. But what you don't see in either of these definitions is any specificity around how much. And that's because impact investing can be something that is targeting the same or greater financial return for something that has no impact intentionality involved, or sometimes it intentionally is targeting a lower return, which some people refer to as concessionary returns or catalytic investments, because they believe that by lowering the financial bar, you can actually generate a certain type of impact that otherwise investors wouldn't be able to invest in. We'll talk more about that throughout the presentation. Now, a lot of people have the question of, is impact investing ESG investing? And so I put up a couple of definitions here for you to see around ESG. Again, people will talk about it differently, but I think the core definition that you see here is that there's a really, the intentionality here is not to generate a certain social impact outcome like impact investors, but an intentionality to, fully, systematically, in an integrated way, assess the environmental, social, and governance factors or influences over a portfolio and a company that may result in potential risk, greater risk or less risk based on how it's managed, as well as opportunity. And so ESG investors are committing to considering this and doing a good job assessing it, but it leaves out the explicit goal of generating a particular type of outcome. These two can be managed, together. I would say most impact funds have some ESG component as well, but most ESG funds don't have an impact component. And that's an important thing to know. And so across the spectrum, as I mentioned, you could be targeting specific outcomes, but also avoiding exposures, which was really the beginning of where this movement started, of exclusionary screens, or saying we're not going to invest in certain industries because we don't believe that they're contributing something positive to society, or more explicitly, maybe they're contributing something negative. And ESG integration in the middle is really the full integration of all of these effects. And if you look at the history of it, as I mentioned, it really got started, actually well before the 90s, really with a group of religious investors initially, the Quakers and Catholic investors as well, saying we don't want our portfolios to be misaligned with our values and our mission. And so they had these exclusionary screens. And that led into a wave of divestment movements, beginning with apartheid in South Africa, and a group of investors led by religious investors actually saying, we're going to divest or no longer invest in companies doing business in South Africa to try to influence those corporations to move their operations out. And it actually had a very meaningful impact on the end of apartheid. That was one of the things I studied back in college that led me to believe there's some real efficacy to this type of investing. It was really in the early 2000s that we saw assets start to grow. And that was right around the time that I mentioned at KLD, I was helping to sell our research and indices to mainstream firms, where this was no longer just for values aligned or mission aligned investors, but really the idea that all investors, whether it's individuals or institutions, should be considering this because it actually has some financial materiality. And what came after the broader adoption of and mainstreaming of ESG is this idea of impact investing, where investors are targeting a specific outcome. In many ways, I think this portion of the field came out of a dissatisfaction with ESG. Hey, the assets are growing and people are doing this, but what is the outcome? Is it really leading to any difference in the portfolios or the corporations? And so investors started to say, we want to target those outcomes. And the word impact investing was coined in 2007 with that idea. And so the Industry Association, the Global Impact Investing Network, started measuring the assets in this field in 2013. And you can see that it's grown quite a bit, but it still dwarfs or is dwarfed by the assets in ESG. Today, if we segment or treat this whole space as one big tent and look at the different strategies with them, again, sometimes they're overlapping. These don't have to be mutually exclusive. We still see the most assets in exclusionary or negative screens, followed by ESG integration, shareholder engagement, thematic screening of portfolios, and finally, impact investing, very small. Yet if you look at the growth rates, the CAGR over the last few years, the growth is really coming from the more intentional impact investing and screening as well as ESG integration. I personally believe that all investment firms, at least those that are well managed, are going to have a highly sophisticated approach to ESG integration across the board. It's just going to become business as usual for the investment industry. And so I think we'll continue to see that fast pace, but impact investing, I think, will always be a subset. So I want to frame this in the context of the broader investment industry, which is that it's really a bifurcating market. We see huge gains year after year in passive investing, index investing, because of the low fees. The data has shown that beta is really driving returns over the last market cycle and even before that, as well as highly differentiated strategies, venture and private equity, private credit, gaining a lot of share. And the strategies that are somewhat differentiated, like active management, they're not in like the value creation of the manager is sometimes questioned, but it's not purely indexing. They're losing market share. At the same time, we're seeing boutique firms, which are highly differentiated, have a particular domain expertise in a sector, in a geography, in a particular strategy, gaining share, as well as giant asset managers also gaining assets because they offer certain advantages for large institutional investors as well. And it's the medium-sized firms which really struggle for relevance because what they're doing is not necessarily differentiated. And so this is where I think, that along with some of these other trends here in terms of investors having greater demand for customized strategies and transparency, fee compression, technology disruption, and just the enormous transfer of wealth to women and millennials who are really showing that they invest with their values more and more. This is all in favor of and really great tailwinds for the impact investing industry, which really responds to this in terms of who the investor is, what motivates them, what they're expecting of investment firms in terms of their customization and their outcomes, and that fact that impact investment firms by nature are highly differentiated and focused and bring a certain domain expertise that mainstream investment firms don't necessarily have. So now I'm going to go a little bit more deep into what really counts as impact, because I hear a lot of folks frustrated by the field in terms of, we see some investment firms defining impact this way and their portfolios look like this, and someone else totally negates that. And what they consider impact investing is completely different, and their portfolios look nothing like that. Or quite frankly, their portfolios look just like non-impact funds. So what really is the difference? So let's try to dissect that a little bit. The first thing to acknowledge is that it still is up to the investor. Impact is in the eyes of the beholder. And that is why the asset management industry has taken so long to respond to this demand. Because if every investor decides on their own, then it requires customization. And this is an industry that's predicated on scale. So it's been difficult. And where there have been overlaps in terms of mission and certain values, they create their products, but otherwise a lot of investors are really left hanging. What's really changed is the development and the acceptance of the UN Sustainable Development Goals, which are 17 social and environmental and governance issues that everyone can agree are universal problems worth solving. That if we devote capital and if companies are developing products and solutions and services to solve for these, we will all benefit. And that consensus and investing into what are shared societal problems and needs makes it easier for the asset management industry to respond. It's still very high level, and we find that certain investors and firms may focus on one of the SDGs or several of the SDGs, which we'll talk about. And at the same time, if you peel the onion back in any of these, you'll realize that there's still a lot of subjectiveness to each one. What is quality education? For whom? Et cetera. And so Impact Engine and what I've really personally also subscribed to is just a really nice, simple model for starting to peel the onion back and really assess impact is what we call the 5P framework. And the 5Ps describe 5 core levers any business has to drive impact if they so wish. It helps us evaluate and understand where the company could be driving impact and whether they're doing it. underlying all this is the same principles we talked about in the beginning around intentionality and measurement. But just to give you a few examples, place-based impact investment is focused on companies where they are intentionally choosing to locate their operations or headquarters in a particular geography in order to create a certain type of impact. That could be emerging markets at large. It could be opportunity zones. It could be urban areas or rural areas for that matter. But it follows not just the desire to do it, but an actual business strategy to create impact in that particular geography. So L&J is an example of a company based in Liberia, intentionally based there. They are a fashion and apparel manufacturing company in the denim space. And they chose that location because that's a country which, statistically has shown low enrollment for children in education in schools. And at the same time, low employment of women. And L&J, created their manufacturing facility there and explicitly has hired women and has shown that, by employing women and making women the income earners in the families and also the decision makers, a much higher incidence rate and enrollment rate for the children of those women who are their employees versus the broader country. People-based impact is closely related to place because there is, correlation and intersection in terms of locations that are under-resourced as well as the people and communities there. And so this is the intention to specifically employ or the owners of the business to, again, strategically leverage and better resource certain populations. So Maven, some of you may be familiar with, is a line of hairstyling products, and it's specifically sold by stylists who otherwise are not typically getting commission from the products that they're selling. And so this gives them the benefit of economic empowerment and additional income from selling products themselves. Process-based impact is the one that I would say is most closely aligned to the broader philosophy and principles of ESG investing, and that has to do with how a business conducts itself. If we look at their supply chain practices, their HR and employee engagement practices, and everything in between, it's companies who are really, again, what's different from ESG is there's this intentionality around, we're going to manage this in a certain way to create a certain outcome. So Patagonia, for example, the clothing itself, is not, I would say that's not the biggest impact, but it's the way they make it. They're focused on sustainability of the raw materials for their products, as well as their highly engaged employee base. And I would say taking it even a notch further in terms of their environmental campaigns and support of environmental policy. All of that has built a company that is trying to create a certain environmental impact through the clothing that they sell. Product impact focuses on one step deeper than Patagonia in terms of the actual design of the product and what they're selling is specifically driving a certain outcome. So D-Light is a solar LED lighting company specifically sold in emerging markets where it's very common to have blackouts and brownouts and you don't have access to lighting. So for every solar lamp they sell, every widget and product-based impact company sells, they're driving more impact. Of course, we want them to be managing their process and ESG and business practice as well too, but the intentionality is around, we actually created this product to create this impact. And finally, paradigm is really businesses that are created, structured, selling, owned in a way that's completely disrupting a paradigm. Coursera put prestigious higher education online for free and fundamentally disrupted our education system. At Impact Engine, we're also starting to make investments in employee-owned firms. And this falls under paradigm-based impact, which is saying if we structurally change who owns the company, we can structurally address wealth equality in our country. That's not dependent on certain, tax policy shifts. When you're evaluating impact in a company or evaluating a fund which is telling you they're creating a certain type of impact, you can, again, start to assess it a bit further by asking questions like you see on the right, which the Impact Management Project has put together, these 5 dimensions. What type of impact for whom, how much, what's that specific business or enterprise or investor's contribution to it, which is sometimes called additionality, and risk. What's the social risk? Investors look at financial risk, they should look at the social risk. When you ask these questions, it leads you to naturally start to develop a thesis or a hypothesis around what is the problem, what is the solution, and why you think this company or this investment will help solve for that. And what you see on the left here is what's commonly referred to as a logic model or a theory of change, which begins with thinking of the inputs. What is the company or the investor putting into the enterprise? What are the activities that they do with that? What are the outputs that come from that? What are the outcomes in terms of the real social or environmental impact? And what's the broader impact on society or communities or the larger system? These can each be measured. And as we talk about measurement next, you'll see that at the end of the day, we want to be measuring impact, but there is, it's not always achievable and practical to do. Both because of the time horizon in which you're an investor. By the time you see the additionality or the impact, the holy grail here, you may not be an investor. And so if you're measuring to create the impact or measuring even to decide whether there will be impact, right? To make the decision, how can you do that if it hasn't been done yet? And there haven't been randomized control trials, for example. And so what is more common, and I think a best practice for a lot of firms, which are really committed to this, is to focus on those outputs and sometimes outcomes, if it's achievable, to validate that final impact or additionality that's in your thesis. And so there should, it takes some real analysis of this, and you need some proof points or evidence or reason to believe that the outputs will create the outcomes, which will create the additionality. But measuring outputs is just much more achievable and practical for investors and companies. I also want to say that the industry often faces a lot of scrutiny around the lack of standardization of impact measurement. Some firms are doing it this way and some firms are doing it that way. That is true, and it's a real opportunity for anyone looking to get in the field to do it right, to potentially even build your own firm, which helps establish this. And at the same time, it's not true, in that sometimes people are just talking about different things. So for example, there are ratings providers like GEARS or MSCI and Sustainalytics for public companies, which are providing ratings like an A, B, C, D, or a gold, silver, bronze. And that's across a portfolio. And it's really trying to, in some ways, by standardizing and boiling it down to a rating, they're not really focused on that impact outcome at all. They're just more rating the business practices. And it's a totally valid thing to do, but I wouldn't call that impact measurement, as we've been talking about. That's ratings. And there is some standardization there. On the other hand, a lot of folks are focusing on the SDGs. There's a lot of consensus. There's standardization around the use of SDGs, but that is also not measurement. That is goals and targets. You can measure the amount of dollars that are going to the SDGs, but it's not actually explicitly a measurement tool. In the middle, we have the Impact Management Project, as I mentioned, which is a framework that there is buy-in, there is standardization. People agree. This is a good framework that a lot of people are using to be able to develop an impact thesis, which then does help you develop the metrics and measurement. And there, I have Iris Plus listed, which is a great tool you can look up online yourself. But I would say that even Iris Plus, which is a standard system, it's all customized. It's bespoke per company. Because a company whose outputs and outcomes have to do with the reduction of greenhouse gases has a totally different KPI or metric than a company that's focused on educational outcomes. And so what we need is not standardization around one measure. It's not something you can unitize and aggregate like that. It's not an IRR. It's standardization around how you measure impact and what you do. And there are standards like the IFC and PRI and others, which are helping to create the standardization around here is what it means to be an impact investor in terms of establishing goals and targets, having metrics for each investment, using frameworks to develop those metrics. And here are ratings to rate your entire portfolio. So there's a lot of room for improvement. And I really view that as an opportunity, but the field is also already doing quite a bit. The other question folks always ask is about return expectations. We touched on this a little bit in the beginning. Does being an impact investor cost you something? Or does it make you something extra? Is there a certain risk involved? And I will say, as you can see on this matrix on the left here, it's yes to all of it. It depends what your objective is. And again, step back. That's actually true for all financial investments. This idea of risk return, it's, by the way, not always linear. Sometimes, you're getting greater reward for the risk you're taking. And sometimes you're taking more risk than the reward you're getting, not necessarily intentionally, but because there's something called, luck and skill. This is not it's not always predictable. And also, investors have different portfolio needs. Some investors have certain liquidity needs. They have certain tax needs. They have certain concentration limits, diversification needs. And sometimes that results in them targeting a lower return to achieve that. And I think of impact as just another dimension of that. It's one more thing. And so when you're intentional about assessing it and managing it, you can go in eyes wide open to say, we think we're taking this added risk, or it's actually reducing our risk, or we think it's actually going to drive better returns because that product-based impact leads to a competitive advantage that their competitors aren't capturing in their product market fit. And so I would argue in the upper left quadrant, ESG investments, again, without some specific end impact goal, it's just better investing because they're looking at more data points and better understanding companies than folks who are just saying, I'm not going to pay attention to ESG. Why would you ever do that? It's not even rational. But within the right quadrant, I would say that there are firms which are plotted right on that diagonal line, which are saying, generally we're targeting the same. And there are companies, there are funds which are more financial first, saying, look, we're targeting these returns and we're considering impact. And, we don't have like necessarily a bar or a certain standard or impact. We just want it to be positive, world positive. One investor uses, for example, that terminology. And others are saying we're impact first. We need to have these outcomes in our portfolio. This is what we're promising. And we will generate a certain return. Maybe it's 10%, 15%, a 2x return, a 1.5 return, whatever it is. But it's more like they're optimizing for that minimum or approximate return and maximizing the impact, right? Versus maximizing the return, the financial return, and optimizing for the impact. And this is the nuance and subtlety that I think people miss. And when you really drill down to the examples, which we will, you'll start to see this come out. The other thing I want to say around ESG is, as I mentioned, I think it just makes you a better investor. The ESG field has a much longer history. It's a lot of it's grounded in public markets data. And so the data sets are longer and deeper. And most of the academic research you will see actually points to some type of advantage, material advantage, to companies that really manage their ESG factors, which is again why more and more investors, all investors are taking this into account. And finally, before we head into the next part, this study was done by Impact Capital Managers, which is an association of market rate impact funds that are targeting the same or similar financial returns as other private equity and venture funds. And we looked at all the firms in the network, which includes Impact Engine. We participated to really look at our portfolios and try to articulate and model what actually is it about being an impact investor that can lead to alpha or superior returns. And so you see these three categories here in terms of being able to access opportunities because of our impact angle and resources, being able to create a certain type of value that other firms can't, or being able to strengthen those outcomes. And on the right, how these actually translate into a source of financial value. So can it be done? Yes, but it needs to be intentional. It's not the idea or the aspiration of impact alone. You have to have a real strategy behind it that's concrete, and you have to manage it. And if you're going to manage something well, you need to measure it well too. So that is where we will pause right here before we go into focusing more specifically on investment strategies for impact investing.